Hello and welcome to Nolan Financial Radio. My name is Chris McKinney from Nolan Financial Partners. If you'd like more information about what you hear during our show today, give us a call at 719-210-4242 or visit us online at nolanfinancialpartners.com. And while at our website, click on the radio page, check out our past shows, and subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. When the Federal Reserve recently announced a rate cut of 50 basis points, that's moving it down to 4.75 to 5%. It set off a lot of chattering within the financial news sector. Is this good news or is this bad news? What does it mean for retirees? What does it mean for home buyers? All excellent questions. And during today's show, we're going to discuss what the rate cut means for the average American. But before we dive into this timely topic, let me introduce you to my co-host, Tony Schur, who I'm sure is already eyeballing a vacation home thanks to this rate cut.
No vacation homes for me, Chris. In fact, my motto is I don't need a vacation home. I just need a friend with a vacation home, right?
That's right.
Just might have to go off season, but yeah, I just need friends who own Airbnbs. That's what I need. Or timeshares.
That's why I'm the financial advisor for all my in-laws. So I'm trying to help get them to see that they need to get that home in Hawaii.
That's right. That's right. That's right. Why do you think I've co-hosted a radio show with a guy from Hawaii for years, trying to get that offer, waiting for him to open that up? Hey, come out and stay with me. Right. Yeah. So, but yeah, I mean, my wife and I are thinking of downsizing, and we were looking at it. And of course, right. Because our kids, we're empty nesters now, because all three of our kids are either in college or married and moved out. Adam's married and moved out, place of his own. Our middle daughter has a place of her own, and she's finishing her last year in college.
You got to downsize quickly before somebody comes back.
Yes. And then our youngest is in college. So we're like, we want to downsize into a one-level home, no stairs, so we can age in place, right?
Nice.
Yeah, we want a place that's going to be user-friendly as we age, so we don't need assisted living. We can have in-home health care. We want one-level living, and we've been looking at that for the last 4 years. But with inflation and interest rates, they raised them.
Yeah,
we've been, I don't want to do that, right? So a lot of people are hesitant to move because of higher interest rates, I think. Well, we've got I should preface it, our current mortgage rate for our house is 2.9%. Don't want to give that up.
Just remember, you're always buying in the same market you're selling in when you go from one house to the other.
Good point.
So it's sometimes it's not as important,
right?
About the time. You can't time a real estate market very well.
No, it's hard, right?
Yeah.
Ask
everybody in 2008.
Yeah, exactly.
People were, I don't know how many homes I bought in 2009 and 2010 that were investor homes that they just abandoned.
That's crazy.
Yeah. They just walked off and let the bank have them.
The market was so bad, the housing market.
Yeah.
That housing bubble just blew up in 08 and 09. But we're talking today about what this Fed rate cut means. It doesn't necessarily mean mortgage rates are instantly coming down because they cut it another 0.25%. The last cut a couple of months ago was 0.5, half a percentage or 50 basis points. Now it's 0.25, 0.25%. And rumor has it that maybe next month they'll lower it again, right?
Yeah. So we're seeing a good trend for inflation. And so inflation is kind of the driving factor for the rise in the federal rates, known as the prime rate. This rate is set 8 times a year, so they meet like twice a quarter. By the Federal Reserve Open Market Committee, they meet to discuss it. If the inflation is under control, lower the prime rate. We've had prime rate uh, historical lows over the last 15 years since 2008, trying to stimulate the economy. They lowered the rate back then, and it's been below 2% until the big hikes we had when inflation hit.
Well, yeah, and I think this topic is huge, and it's good to look at interest rates because they do affect you, and on both ends, right? I mean,
That's right.
if you're older and in retirement, lower interest rates aren't necessarily a great thing because you want to be able to earn as much on those safer investments, right?
That's right. So maybe you want a higher interest rate because you've got money market accounts and things that are going to be directly affected by this rate cut, right?
Right.
So the rate that we're talking about is the rate that the Fed sets that determines how banks loan to each other, right? So banks borrow and lend to each other all the time. It's kind of how they move money around. They do it with notes, and so it's not the rate that an everyday person will pay. So it's not going to really change much in household budgets. Hopefully, more it'll be that inflation has gone down. The biggest thing for people, most people, will be that their credit card rates might go down. So not for my clients, because all my clients pay off their credit cards monthly. They do not get interest charges on their credit cards. But you're going to not really see that in your daily budget, a big change.
Right.
Now, if you've got like a home equity line of credit, those are often set to prime. So those do go up and down. So if you've got money sitting in a loan situation in a HELOC, that may be going down.
Yeah, we have a HELOC that we owe money on that we've spent for home repair, and it did go way up, and now it's coming back down. So that was more directly affected. You're right. But you mentioned credit cards in there. I want to say credit card rates are outrageous.
They're as high as 30%, right?
Yeah, above 30%. I heard.
Yeah.
And we've
I've got
mentioned
one
that on
that
past shows. Loan shark rates, right? I mean,
it's terrible. I mean, that's so 30 cents on every dollar. Think about that.
Crazy. That's crazy.
And then they compound it monthly.
Yeah, it's compounding interest at 30%. That's nuts. Even if you think, oh, mine's not that. Yeah, it's 25%. Okay. I mean, that's still, you're still paying a third or more than you would. I mean,
it's above 10. You need to make sure you're paying those things off. I mean, that's really
oh yeah, you should pay them off regardless because you don't want to pay that much extra for anything. I mean, you buy stuff on sale because it's 10% off. Would you go, oh, I'm gonna, for convenience sake, I'm gonna pay 10% more for everything I buy, or but I mean 30%. That's 30%. Crazy. I don't know why. I thought there were laws that on what you could charge in interest. There should be, in my opinion, but banks would never allow that to happen, I suppose. But there should be a cutoff.
Yeah, there's some. There's consumer finance laws
for predatory lending.
At predatory lending.
At one point, but they don't apply to Visa, MasterCard, or Discover, or any of those. So at what point does a credit card become predatory lending? Pretty much from the get-go at 25+%. I mean, if that's not predatory lending, charging 30%, what is, right?
Right. So, I mean, you might be able to get better rates down at the local pawn shop or
seriously.
what Western Union, I think you
Yeah.
can get, payday loans,
Yeah, when a loan
payday
shark
loans.
is charging you 20%
Right.
and Visa is charging you 30, there's something wrong here, right? I mean, that's
Something wrong.
crazy. But but it is good that rates are coming down for a
Yeah.
lot of people, for a lot of things, because they got up so high. We're reaching normalizing territory, and I think
Yes.
the Fed's done a pretty good job of bringing us down for a soft landing. I mean, you can
They
always
have.
react soon enough, and they could have prevented some of the
They could have started the rate hikes earlier. They were slow to do that, but I mean, guess what? They're conservative guys. They're
yeah.
not going to move.
No,
Guys and gals. They're
Jerome
not going to
Powell
move
isn't
fast.
one to take any
Yeah.
crazy action, right?
No, no, no.
I mean, you're a good friend of his. You can call him up.
Well, and we want our Fed to be conservative and be
Right.
and not just jerk reactions. We don't want these
Yeah,
rates
you don't want a knee-jerk
moving
reaction.
around, because then the banks don't know how to prognosticate how their money goes, and that means that if they have that volatility from the Fed, then they're going to pass that volatility on to consumers. So
Yeah.
volatility means they're going to charge you more because they don't know what are going to happen, what's going to happen with rates
Yeah.
for lending, for HELOCs, for mortgages, for whatever you're doing.
Yeah.
Student loans would just continually be higher if the Fed was more volatile, all those kind of things. So the fact that they move it slow and are conservative in their movements makes lending more predictable.
Sure. Yeah, and everything does better when it's more predictable and things have
Yes.
stabilized and normalized. I mean, we've seen the market respond well to that. Um,
Yeah.
I
Very
mean,
well.
for somewhat normalized. Well, yeah, I mean, you have I think the fact that it was a decisive win and it
Mhm.
wasn't drug out. Whether you love him or hate him, Trump won decisively.
Yeah.
They thought it was going to be much closer. It was still somewhat close, but they thought it would be closer. But the Republicans won decisively, and
Mhm.
the market likes that. They don't like uh, the undecisive or the
Right.
unknown. And so that, coupled with the day after the election, the Fed lowered the rates. The markets loved life
Yeah.
there for a few
Yeah.
days, didn't they?
They
So
really did. They
yeah,
had good indicators of knowing what was going to be happening with the
yep,
economy, because Trump's laid out a bunch of different things he wants to do. So they
yeah.
know those
Extend the
things.
tax cuts. They
Right.
liked that.
And then we got the rate change.
Yeah,
So it really had a couple good indicators for the market
sure.
to have a rise.
Sure, but whenever it has a rise that big and that quickly, usually
We have a
y
fall.
there's gonna be a correction at some point. We
Sure.
know that. I mean,
Because
nobody has a crystal ball.
valuations are really high right now. Yeah, they've been high.
Yeah, it's gonna have a correction, that's for
Sure.
sure. The valuations are outrageously high, so, yeah.
But, here in Colorado, you can't get into a house for less than $400,000 that
No, you can't anywhere. I
in
mean,
a decent neighborhood.
and I'm telling you, Worthington, Minnesota, where I grew up, a small farm town in Minnesota. I mean, small, it's 11,000 people, right?
Mhm.
Not that town has had struggles, it has issues. A lot of farming community. The main employer is a meat packing plant. For a decent house there, $400,000 right now. I mean,
That's
used to be
crazy.
there was a huge difference between like living in the Twin Cities, like the Minneapolis St. Paul area, in one of the nice suburbs. You could get a house, and if a house there was $400,000, the same house in Worthington would be less than half, right?
Yeah.
Now it's equal. That's what scares me, is that no matter where it's at, houses are
Right.
expensive. It doesn't matter if it's in some tiny podunk town, you can't get internet, or if it's in a big city. And it used to be like, well, if you're in Colorado, everybody wants to live in Colorado, or Florida. Of course, houses cost more there. Nope, they're that expensive everywhere. I mean, there
Wow.
are places that are more expensive, like
Right.
California. I mean, there are places that are crazy
Yeah,
expensive.
it's double out in Cali.
Yeah, yeah.
Yeah.
I mean, but at the same time, I looked at this house, nice house, but it's not nicer than the one I live in, and you couldn't get that. I mean, it's crazy. So
Yeah.
the housing market has kind of gone crazy. But what I want to ask you is, with the interest rates doing what they're doing, people shouldn't get emotional one way or the other. Like
No.
when the stock market hits record highs, I think people make emotional decisions, like they get
That's right.
excited, like, "Oh, I need to put more in," so they end up buying high, super high, and then when it drops way down, like when we do have a correction and it goes down 15, 20%, they're like, "Bail, bail." So that's why the
Yeah, yeah.
majority of people, over 50% of investors, buy high and sell low. Isn't that crazy?
That's crazy. That's
Because they're
crazy
not
that
working
that
with
still
you.
is still a statistic that still holds today. It used to
Yeah,
be like 60 or 70%
right.
back in the 80s. But now we're in their information age, and people are a little bit more aware, so it's not quite as bad as it
Right,
used to be.
but it's still over
Uh,
half.
Still over half. Yeah. So
That's
yeah,
crazy. But
so
you have to work with a financial professional who's gonna take the emotion out of it. They're gonna tell you what
that's
you
right.
need to hear, not what you wanna hear, and they're gonna
We
say, "Whoa, wait, let's look at where you're at, and let's make
right.
smart money moves based on your goals," right?
We make rules-based decisions, and we make decisions based on experience, based on what we know, has happened in the past, looking forward. We don't know what's gonna happen in the future, but, we use our experience and we try to do the best job we can of taking care of our clients.
Sure.
Um, Hey, Tony, I wanted to mention that we've set some complimentary consultations up for this coming week. We have Tuesday, Wednesday, and Thursday available. We work until 6 o'clock, so you can have a
Mhm.
later appointment. Give us a call at 719-210-4242 to set up that appointment, and we can talk to you about how these things are going to affect you and what you should be doing with your retirement to make sure that you're in good shape for all
Yeah.
the changes that are going to be happening. Give us a call, 719-210-4242. Our website is nolanfinancialpartners.com if you want to check us out some more.
All right. Well, that sounds great. And again, it's Nolan Financial Partners.com. And Nolan is Nolan, in case you're listening on podcast and can't see the video. The
Right.
video is also available on the YouTube channel, the Nolan Financial Partners YouTube channel. Chris, great show so far, talking about the Fed rate cuts, first a
Yes.
half point and then a quarter point the last couple months. And, rumor has it, nobody has a crystal ball. The Fed can be unpredictable, but typically they indicate what they're going to do. And it looks like they may lower it again by a quarter of a point in December before the end of the year. We'll see.
Right. Right.
Um, so with interest rates coming down, now is the time to reevaluate where your assets are at, especially if you're over 50 and have a lot of retirement assets that are tied to the market. You might want to look at your allocation, and you always want to do that at the end, before the end of the year.
Right.
Work with a financial professional like yourselves, a trusted financial professional who's going to look out for your best interest and look at your personal situation and reevaluate, maybe readjust that asset allocation, right?
Yeah, that's right. There were a lot of people that were getting into the inflation bonds. A few years ago, inflation went nuts
Yep.
because they're paying quite well. Well,
Yeah.
guess what? Now they're not.
Right.
There's a time to look at those and say, well, are these still serving my needs? Right. Same thing with CDs. We saw CDs as high as 5%. Well, the average rate is down under 2% now.
Yeah.
You still find the few that are high. You have to look hard though, and you have to want to use a bank probably that you don't have a relationship with.
Right.
So a lot of people don't like to do that. So there's a lot of things that are going to be changing for what we call fixed uh, fixed price rate, investments, right?
Yeah,
So a lot of those things are going to be coming down or have come down, and they need to be looked at to see if where we could convert those to, maybe lock in some of the good rates that we still have before the rates come down, and so we can get those things locked in. There's some good products out there that you can
sure.
take advantage of.
Oh, there are, and there are a lot of options. And don't be fooled. I went last week. I had to take Friday off, as you know, last week when we normally record our show, to go down and help my dad with some banking. And
Oh,
he banks at a small bank there in Worthington, Minnesota. And we went in there, and I saw their ad. They always advertise what their latest promotion is for CDs.
hmm
And because my dad was getting his land rent check, and he goes, "Should we put this in a CD?" And I looked at the poster, their best rate. It was over 4%. It was like 4.3 or 4.4%.
that's
But
awesome for a small bank.
it is, but the term was 5 months. 5
Right.
months. I mean, you
That's
can
right.
lock that in for a whole 5 months.
All 5
It's
months.
like,
Right. So that's
I'm
the
like, a
challenge.
5-month CD. That's
Right.
crazy. Okay, we can
Yeah.
lock that in for 5 months, which would be fine. But the problem is, in 5 months, they're gonna lower that rate, and they're gonna
More than likely.
automatically roll it over if you don't fill out the paperwork to take it
At
out or change it.
at the new rate, not the old rate.
Yes, no. After 5 months, it switches to whatever the new rate is. And so,
I think you have like a 1-month grace period on that, right? Something like
I
that?
think you have 30-day grace period, but my
Yeah.
dad missed it on the last one.
Yep.
He had a 12 or an 18 month, and he didn't do anything, and they sent out a notice. And
Sure.
unfortunately, at that time, I wasn't getting the notices. They mailed it to my dad. Gets everything by mail. He doesn't have email. Now I get all the notices too. I have full financial power of attorney. But this was back a couple of years ago before I had that. He
Right.
let it pass, and it went from this great rate of like 6% for 18 months, or five
Mhm.
something, 5.7 or 5.9 for 18 months. That lapsed, and a month went by, it lapsed, and then by the time I found out about it, I said, "Oh, what can we do?" And it dropped to, like, I don't know, 4, and they re-upped it for like 3 or 4. And that's back when the
Right.
rates were still pretty high, so we weren't making as much. And now we had to re-up it, and the re-up was 7 months. Now I see it's down to 5 months.
Sure.
Yeah. And you have to
Well,
re-up it at a new rate, take it out, do a new CD at that lower rate. That's the problem.
that's a problem. Um, and the other problem sometimes, so banks are also marketers, right? And so they'll market these rates, but they're really new money rates if you look in the fine print, right?
Yes.
So the rollover rates aren't as good as the new
Nope.
money rates.
No, that's why I said you have to take it out, come back in the next day, and open a CD.
That's right.
That's what's insane, right?
Yeah. So
And you have to look at
they
the
take
fine print.
advantage of people that aren't paying attention.
Right, and you have to look at the fine print too. There's a certain amount of rate. They said they had a savings account that they were paying 3.2% on. I'm like, "Dad, let's take some money out of that checking and put it into the savings account."
Yeah.
Well, it's a $70,000 minimum, I found out. Okay, well, he
All
didn't
right.
have quite that much. So I'm like, and you have to have that, maintain
That's
that to get that. It's like at that point,
oh
you
my
if
friend.
you have to maintain that constantly to get that rate, why wouldn't you put it in a CD or a MIGA or anything that could make
I, s-
more than
I I was about to say we got some good MIGAs right now that,
yeah,
that would probably serve him better. So
yeah. Isn't
yeah,
that crazy?
yeah. So there's
Yeah. You got to
so
be
so
careful.
so if you don't know what MIGA is, it's multi-year guaranteed annuity, and basically they're fixed rates.
It's like a
And,
CD, but from an insurance company rather
yeah,
than a bank, basically, right?
and so they have a much longer lock-in rates,
Yeah,
and you can lock in the rate for like 3 years, and you lock
yeah,
in the rates that are now, and so they still have some that are over 5, and you can lock it in for 3 years.
That's huge
So
because rates are coming down, and that's huge if you
yeah,
can lock it in for a longer period of time. But those time periods are going to, even with the insurance companies, are going to start shortening the time periods to get the higher rates, just like the banks have
sure.
started to do.
Yeah,
So you need to take advantage of those things now. Yeah,
that's right. That's right.
yeah.
This is probably going to be the last really good month for those
The
things.
last hurrah is going to be this year. Yeah,
Yeah,
yeah.
the last
By
late
Jan
disaster.
1st, if they lower rates again next month, those will be gone January 1st. There'll be new rates that won't be as
That's right.
attractive or terms. Yeah. Yeah. So it is important for our listeners out there to understand interest rates, how it affects their personal finance. And when the Fed lowers that, a lot of people go, oh, lower interest rates, I'll go buy a house. But it doesn't trickle down like you said earlier. I think we just need to reiterate that fact that just because the Fed has lowered interest rates the last couple of months and might again next month, you don't see that take effect on your credit card interest or mortgage interest right away, do you?
No, you don't. It takes a while for the banks to change things. So mortgage rates, will probably drop, but they'll still won't go down to like pre-pandemic levels. Auto loan rates, you know, they're around 7 right now. They've been coming down a little bit, so they'll continue to come down a little bit. Now, federal loans are fixed for student loans. So those aren't going to change. Now, if you got a private loan, some of those are tied to prime. So maybe some of the student loans might
Yeah,
change. Um, so um, now that doesn't mean you should, if you have a private loan or have a federal student loan and you want to change it to a private loan, that may or may not be good for you. So I'm not saying to do that,
yeah,
just because the rates may have dropped a little bit. Um, so be careful with that.
sure.
Um, you know, so we look at bankrate.com to go check out the top yielding online savings account rates, and so those are that's a good place to go find out where the best rates are for high yield savings accounts.
Yeah. Well, you know what? This topic has been great today, Chris, and we've covered a lot of ground. I know that really, before you do anything, and if you want to know what should I do, should I sell my house, buy a new house? Should I go with the MIGA? Do I need an insurance product? Do I need an IRA? Do I need to reallocate? Work with a financial professional because, Chris, I know everybody's situation is different. You always
That's right.
say that. And have a report. I know you run a report. It's called the Compass Report, or the report you run, I know, that shows, I forget what you call it, but it shows where they're at, where they're invested,
Yeah.
and whether it's conservative or higher risk. And you base it on there. You say, hey, you take this risk analysis. Well, you think you're conservative, but all your money's at risk and you're headed toward retirement. Maybe we want to reallocate. So for our listeners, before we go, how can they get a hold of you?
To reach us, give us a call at 719-210-4242. We'll set up that complimentary consultation when you give us a call, 719-210-4242. Check out our website, nolanfinancialpartners.com.
All right. Sounds great. And that does it for today's episode of Nolan Financial Radio with our host, Chris McKinney.
Join us again soon for another episode of Nolan Financial Radio.